Welcome to this reporting season wrap-up. My name is Piers Bolger and I'm joined here today by my two colleagues in Dom Melchek and Chris Adams. Today we'll be providing an overview on how we saw the most recent first half reporting season here domestically. I'll kick off with some introductory comments in regards to our thoughts on financial markets, as well as our thoughts on equities, and then I'll hand over to Dom and Chris to talk a little bit more detail in regards to how they saw reporting season as related to our two equity portfolios. There is the ability to ask some questions. We're doing some Q&A at the back end of today's presentation. We aim to talk to roughly around about 30 to 40 minutes or so, and then we'll open it up for Q&A post that. So if you do have any questions, just feel free to put that in the chat box down the bottom, and our moderator will pass that through. So with that, I'll get stuck into the main part of the presentation. Next slide, thanks, Hugh. Next slide, thanks. So I think you'd have to be living under a rock not to realise that COVID certainly had a significant impact in terms of financial markets and across multiple fronts throughout the course of 2020. And certainly from our point of view, when we think about portfolio positioning, that was quite significant. However, we look through the course of 2020, and certainly when we think about the back end of the calendar year, the rollout of the vaccine, in our view, is a material game changer, not only to normalisation of the global economy and domestic economy through 2021 and beyond, but equally in terms of financial market performance and the opportunity set that presents. And even though we saw some significant challenges through 2020, certainly through this reporting season, we felt that by and large, it was actually generally a very positive reporting season on multiple fronts. And the guys will talk about that in a little bit more detail. But certainly from our perspective, we expect that growth that we saw through the back end of 2020 will continue through 2021, and certainly view the vaccine rollout as really a precursor to that. And I think one of the most important elements from our perspective when we look at the rollout of the vaccine, you can see here, just in terms of COVID cases, has materially declined through the back end of 2020. And certainly the way that we think about it in the context of the impact of COVID, as we see fewer and fewer cases in ICU units, not only certainly domestically, but certainly right around the world, we think that will create a more normal operating environment for corporates and certainly lead to a more even spread of performance across financial markets, particularly equity markets on that front. Next slide, thanks, Hugh. Now, if we just look at the performance of domestic equities throughout the course of 2020, it was very much a case of two halves, as you can see here. Whilst the broader ASX 200 was able to eke out a marginal positive performance, roughly around about 1.5%, you can see very much at the sector level, there was significant divergent performance. And it was really only the tech sector, healthcare and consumer staples were able to deliver, by and large, positive numbers throughout the entirety of 2020. And then the other sectors were very much in the camp of the first half, where we saw significant challenges as related to what the global economy, domestic economy would look like, and what that then meant for many corporates in those sectors, and how quickly that changed once we saw some significant fiscal response, again, domestically and globally, but certainly as well from central banks in terms of monetary policy and their ability, as I said, to maintain financial conditions that were accommodated in the context of not only a recovery, but equally in terms of the way financial markets behave. And that had a significant impact throughout the second half of last year. And you can see through the back end, particularly if we were looking at the financial sector, and that sector has benefited significantly through the third and fourth quarters of last year, but consumer discretionary as well, as we start to see that stimulus packages roll in through the economy. That, as I said, had a big impact in terms of some of those discretionary spend. And clearly IT, as well as some of the consumer stocks, benefit on the back of that. From our point of view, we sit here today and through the reporting season, that was clearly reflected in the results that we saw for many of the corporates. And as I said, Dom and Chris will talk about that. whilst many of them had some strong results. Some are rolling off some higher comps, and we'll start to see that moderate through 2021 and beyond. And others are just starting through their recovery phase on the back of an improving fourth quarter in 2020. So when we think about that in the context of overall performance for the domestic equity market particularly, the split that we saw through 2020, we don't expect to continue, and we do expect a more even performance right across the market. That does provide, as I said, quite significant opportunities, particularly as a recovery starts to take hold, and we'll be repositioning our portfolios accordingly on that basis over the last couple of months particularly. Next slide, Hugh. And one of the challenges for investing in financial markets is clearly managing volatility. And I think that one of the elements that we saw, particularly through the course of 2020, and certainly talking to a number of people in the market, they often felt that the market volatility was at extreme levels, and it made it very challenged to consider making investments across equities particularly. When we think about that in the context, we certainly did see some cross-market volatility within individual sectors, but when we looked at the volatility of the market as a whole, it wasn't out of whack with what we've seen in previous stress environments, whether or not we look at, as I said, GFC at most notable level back in 2008. And once we start to see those fiscal packages come through, once we start to see policy support in a more overt sense, market volatility did start to decline quite quickly throughout the course of 2020. And when we think about it as we currently sit here today, we don't think market volatility is at extreme levels at all. And we think it's probably, as I said, tracking in line with its longer term average over the last decade or so. So thinking about that from a portfolio positioning perspective, we still remain quite constructive on the outlook for equities particularly, and think, yes, volatility is just part and parcel of investing in the equity market, but we don't see the same level of extreme volatility, notwithstanding, as I said, within some sectors it has been higher than normal. It does point to how you're positioning and how you're managing the overall risk within a portfolio framework, as opposed to simply looking at market volatility on a standalone basis. And that's certainly been the way that we've been trying to manage our portfolios and manage the overall risk within our portfolios. Thanks, Hugh. So in terms of the overall market, one of the positive elements really that we saw through this reporting season has been a recovery in what we would say are the three key elements that you're looking for when you're wanting to invest into an individual company. First and foremost, you want to see earnings growth come through, and you want to see that earnings growth being delivered on a sustainable and growing basis over time. You want the ability of those corporates that are generating earnings and generating profitability to be able to pass through returns to shareholders in the form of dividends. And you then want to be able to see your equity that you're investing in that company grow, and you want to be able to see a commensurate return for that equity risk that you've been putting into those companies. And as I said, we think we're probably at the bottom of the cycle as it relates to the downside that we saw through 2020 in terms of earnings, dividends, and return on equity. And as I said, from our point of view, when we think about this most recent reporting season, one of the key elements that we saw coming through that we felt quite positive about was that we saw very little revised guidance in terms of corporates reissuing guidance in regards to missing out on their earnings and or downward earning revisions through the course of this earnings season. Now, certainly, as you can see here from the two charts, that they were coming off, many corporates are coming off a low base, but we do believe that we're now starting to see the back end of it, as I said, as we start to see the domestic economy as well as the global economy start to normalise, and the ability for corporates to move back into, as close as they could be into a pre-COVID environment. And we think that from here on, we do expect, as I said, the earnings environment to remain positive. We do expect it to pick up through the course of 2021. And that ultimately, in our view, will lead to an increase in improvement both in dividends and ultimately for shareholders, greater levels of return on equity. And we think that that is going to be a positive environment and a positive backdrop for the domestic market as well as equities more broadly on a global basis. Thanks, Hugh. One of the challenges, however, has been more recently that we've seen through the back end of 2020, certainly into the first part of this year, has been the steepening in the yield curve and higher nominal bond yields pretty much right across the curve. Now, from our point of view, we don't see this as a significant negative in terms of financial market performance, particularly equity market performance over the longer term. The challenge that we've seen more recently has just been the speed by which bond yields and interest rates have started to normalise. And you can see here on the chart that by and large, pretty much throughout the entire course of 2020, we've seen, as I said, a flat to downward sloping yield curve, but really that started to turn around through the back end of 2020, particularly really as the vaccine started to roll out, as the view was that the global economy and the domestic economy was reopening. Now, if we really just push this slide back a little bit further, you would see that really bond yields are just simply going back to where they were pre-COVID. And in the context of the market environment, when we think about pre-COVID in that context, we certainly remained of the view that equity markets were still well primed to deliver solid earnings growth supported by a growing domestic and global economy. So in the context of where we're seeing bond yields today, yes, it has been painful in the context if you were investing in bond markets, certainly February in that instance, and it has been a little painful for some level of rotation that we've seen in parts of the market. But fundamentally, from our perspective, this is just a reflection of both the domestic and the global economies starting to move back into a post-COVID normal. And really, bond yields where they are today are still slightly below where they were back in 2019. We expect that to be the case simply because we're nowhere near through COVID as we were back in 2019. But we do expect that bond yields will continue to move higher throughout the course of 2021. Now, from our point of view, we've probably got a high point on the 10-year domestically, around about sort of 2 to maybe 2.5% at the absolute top end. And from a US point of view, maybe 1.75 to a little over 2 in the context of its 10 years. So we've certainly been pressing that over the course of February, particularly for both of those two markets. But we do expect that bond yields will start to plateau at roughly around about these levels. And as the economy starts to reopen, as growth starts to pick up, then we will start to see, as I said, bond yields ratchet further. But the rotation that we've seen and the impact that that's had on the market, we think is a little overdone, to be honest. And we do expect that ultimately fundamentals will prevail. And the fundamentals being that you're looking for corporates, as I said, that are delivering solid earnings growth, can pay dividends, and ultimately are rewarding shareholders through higher equity returns through time. As I said, the bond market is ultimately a pricing mechanism for cash flows as it relates to equities. And certainly in that context, as I said, that has resulted in some changes. But a sensible approach to how do you, as I said, price the cash flows of businesses, in our view, hasn't materially changed. And as I said, the uplift in yields we think is appropriate as the global and domestic economies start to normalise. The one challenge that we would say, and that's certainly been the case more recently, has been the speed. As I was saying, we expect it to probably plateau, but if it continues to move higher at such a rapid rate than what we've seen over the last couple of months, that certainly may present some challenges for equity markets and for investors on that basis. But as I said, we don't expect that to be the case. Recent data points around inflation continue to remain very benign. We've still got significant excess capacity in both the domestic and global economy if we just think about the unemployment levels. And, wages growth, again, remains very flat in a broad sense. Pockets of the economy have seen an uptick, but in a broad sense, wages growth remains flat. So from our point of view, we just don't see that there's any rationale for bond yields to continue their upward trajectory as they have at the same pace over the last couple of months. And we think that by and large, they'll find a footing, and that will be positive for financial markets, particularly equity markets, throughout the course of 2021 and beyond. The other point to note is we've certainly seen central banks around the world, the RBA, the US Fed particularly, reaffirm their views on cash rates. And whilst we do expect that financial markets and the bond market will continue to push hard on central banks and push back in the context of what we're seeing here, we haven't seen any change in the policy front. And in our view, we don't expect to see any change in the policy front as it relates to cash rates. Central banks around the world may start to pull back in terms of their level of quantitative easing that they've adopted through 2020 and certainly the early part of 2021 as the global economy and the domestic economy improves. But again, we feel that will just lead to a more normalisation of the yield curve, and ultimately that'll start to feed through in terms of the quality of corporates, and ultimately the performance of corporates will be dictated by their earnings that we've spoken about previously. So yes, the yield curve has caused a little bit of a ruction in the way markets have behaved, but we certainly don't see it as a significant destabilising impact over the rest of 2021, as what we've seen, as I said, over the last probably 6 to 8 week period. Thanks, Hugh. So with that, how does that then sort of equate to the way that we've been thinking about positioning our portfolios? And this chart here, you can see this is our positioning across the main sectors around our multi-asset solutions from, basically 12 months ago to where we are today. And you can see there that really through the first quarter of last year, we were certainly defensively positioned. We had an underweight position, certainly in terms of those equity exposures. But really, once we got through the worst of financial market conditions through that first quarter, once we started to see fiscal spend and greater support coming from central banks around the world, we repositioned our portfolios accordingly. And really what you're looking at here, if you looked at today, we're probably close to as maximum overweight as we can be in our equity relative to our more defensive positions, whether it be cash or even fixed income in the context of bonds right across the market. Our absolute positions in equities, whether it be global and domestic, is actually equal. This is showing our active positioning, and we actually have been increasing our exposure to domestic equities over global equities. And as the guys will talk to in a moment, really the rationale for that is that Australia, in our view, is in far better shape than many of its regional peers. We haven't had the significant declines from an economic perspective, given the impact of COVID, and we're well positioned now to have a recovery cycle that we think can be quite sustained over the medium term. And as I said, that has resulted in us moving and increasing our allocation both to domestic as global equities, but certainly in the near term, domestic equities. So from our point of view, the biggest risks, as we see here today, are probably more in the defensive parts of the market. We think the recovery that we saw through 2020 can be continued. The recovery that we saw in terms of the reporting season, as I said, the positive aspects that we saw out of the first half reporting season, we believe will only strengthen throughout the course of 2021. It won't necessarily be what it was like in 2020 in terms of the performance and the drivers, but we think that's probably not a bad thing because it does allow the opportunities to provide a better balance across portfolios and to identify new opportunities. And we're certainly spending a lot of time on that front, as I said, looking for those parts of the market that we think can benefit from the uptick that we expect in growth throughout the course of 2021. So with that, I'll hand over to Dom to talk a little bit more detail regarding what he saw as it relates to the most recent reporting season.
Thanks, Piers, and thanks again for everyone who's joined the webinar. In the next section, I'll give a really quick overview of the domestic reporting season, as Piers said, how some of the key names in our core Australian equity portfolio fared with their results, and also just our positioning and outlook in the large cap Aussie equity space in light of the volatility levels that Piers mentioned, as well as the move in the bond yields. So just kicking off with some of the results on the next slide. You can see here that Australian corporate earnings were slightly better than expected, as Piers mentioned, for the half-year results that we saw delivered during January and February. Roughly 170 companies in the ASX 200 released results over this period, with 40% of them beating earnings expectations by our count that you can see here in the middle of the chart. That's a stark contrast to this time last year, where we pretty much had the exact opposite, with more companies missing expectations. While reporting season always provides a great opportunity for us to see how companies are tracking, really we remain focused on long-term investments, and therefore the more important element from our perspective is catching up with management teams and getting an understanding of the outlook and whether or not we're going to be seeing upgrades or downgrades. So with this in mind, just turning to the next slide, you can see here that despite management teams remaining reasonably cautious, again, as Piers mentioned, there were a number of strong upgrades to full year 21 guidance. And as a result, we saw the strongest reporting period for earnings upgrades in the last 20 years. And so pleasingly, the upgrades to expectations weren't just, I guess, confined to earnings recoveries off a really low base. But again, as Piers mentioned, we also saw dividend expectations upgraded as corporate balance sheets remained strong. And also we saw, record levels of capital being raised this time last year as companies headed into the depths of COVID. And so all of this, we believe, is a positive outlook. So turning to the next slide, you can see that overall future earnings expectations were upgraded by 4% during the month of February, which equates to more than 20% now that we've seen in upgrades over the last 6 months. So overall, this makes valuation metrics for the ASX 200 more attractive, or at least more reasonable in our view. Additionally, generally reporting seasons and reporting periods are the start of a market cycle. And therefore, we saw this as a really positive signal. And we think that we can continue to see strong upgrade cycle from here, which, again, as Piers mentioned, would be good, we believe, for the Australian equity market. Turning to the next slide, we can see here some of the key positions in our core Australian equity portfolio that beat market expectations during reporting season. And pleasingly, these companies actually cover a broad range of industries. So it's not just one industry or one segment of the market that's been driving better than expected earnings. So heading into reporting season, we maintained an overweight position in diversified metals and mining industry with the expectation that higher commodity prices would help drive earnings. And our largest active position here, being BHP in the middle of the slide, didn't disappoint. Record iron ore production and higher realised prices helped drive a 16% uplift in BHP's profitability, and that allowed the board to declare a record interim dividend. We don't expect commodity prices to remain as elevated as they are today, but we do believe that BHP can continue to benefit from the global recovery and the Chinese reflation story, and we think that this will drive ongoing demand for things like iron ore and copper. Turning to some other companies, despite some recent share price weakness as a result of the negative impact of yield, sorry, just back on the previous slide, sorry, Hugh. CSL was actually another company that beat expectations despite some recent underperformance. Overall, we continue to see strong demand, but the company did flag some near-term headwinds in their ability to collect blood plasma due to Northern Hemisphere lockdowns. And so as a result, management actually didn't raise their full year guidance. But overall, given that they've already hit 80% of their profit target for the full year in the first 6 months, we continue to believe and maintain an overweight position in CSL on the fact that we think there'll be further upside surprises. A sector that we've also been adding to quite significantly in the past 4 to 5 months has been the financials, and our largest position in the space being Macquarie and CBA that you can see here on the slide. Both have produced really positive updates in February. Macquarie actually upgraded their FY21 guidance twice during the month, and a lot of that was on the tailwinds that they've been seeing from trading and storing oil and gas in the US, and specifically Texas, where energy supplies have been heavily impacted by the snowstorms over there. CBA, on the other hand, they've benefited from the improving domestic economic backdrop, and as a result, this has led to a significant reduction in the loan deferrals, which we saw spiking this time last year. I guess it's, from my perspective, it's pertinent to point out that although we've been adding to the banks in the recent months, and we've benefited from the strong rally that they've had in share price moves, we view this as really an improving asset quality and dividend play and not a long-term growth play. We think that revenue growth is likely to continue to remain negative or flat at best for the remainder of FY21 and then through to next year in FY22. So overall, that closing out is more a short-term positioning. Some of the other key companies that we can see here on the page that we have overweight positions that delivered strong results include Building Material James Hardie, who upgraded their full year guidance by close to 11% on the back of strong housing data in the US, as well as household names like Woolies and Bunnings and Kmart for Wesfarmers, who also delivered really strong operating results. I'd love to say that we only pick winners and that everything that we invest in outperforms, but unfortunately, there's a couple of companies that didn't hit or beat expectations on the next slide. And you can see here that, as a result of a couple of companies missing expectations, they also have lagged in recent share price performance. One of the names, Alumina, with over a third of global aluminium demand coming from transport industry in the form of, trains, trucks and aircrafts. Aluminium and Alumina is a company that was heavily impacted by COVID and the lack of travel and vehicle replacements over the last 12 months. But despite the softer than expected results, we think that Alumina remains really well positioned. It's one of the lowest cost producers, which is important from our perspective. And we do expect the global recovery to continue to gain pace, as well as mobility picking up. And we're seeing new plane orders actually starting to pick up over the last month. Sticking with the topic of mobility, toll road operator Transurban's result was also highlighted really the sensitivity to traffic volumes for localised lockdowns that we saw, particularly in the northern beaches of New South Wales at the end of last year, and the extended restrictions in Melbourne as well. But overall, despite some of these misses, and particularly in the Transurban case, we think that longer term, the asset quality remains very strong and the pipeline for growth remains attractive. Just turning to the next slide then, I'll just spend a moment to reiterate the impact of rising bond yields that Piers spoke about and try to put it in the context of Australian investments and the Australian equity market specifically. You can see here on the left-hand side that the recent spike in nominal yields as equity investors got a bit of the jitters around the prospect of rising inflation has really driven the Australian financials sharply in the last few months, and you can see that pick up quite strongly. The middle chart, however, shows that break-evens, which is really how bond markets have been viewing the global economy, they've been pricing in reflation for a bit longer, so it's pretty much since the middle of last year. And this has really been driving cyclicals like the oil and gas, materials and consumer stocks. And lastly, the real yields, which is essentially controlled by the central banks, they've really been put to the test by the market to see if policymakers can maintain this lower for longer official rates that Piers mentioned. And a lot of that's been driving the growth sectors like tech and healthcare over the last decade. And so that's been really put to the test. And you can see that those three yields have a really strong correlation to different segments of the market. It's quite tough to see how or where rates will go. And as Piers said, we think that that might be a little bit overdone, but even if yields continue to move higher, just turning to the next slide, what we really want to make sure is that we build a really diversified portfolio that we think can benefit from multiple scenarios, whether yields flatline from here, whether we see a couple of months more of spiking before they plateau, time will tell. But ultimately, we want to make sure that even though rates might drive some near-term movements, we want to maintain a disciplined approach to looking for quality companies that we think can grow earnings through a full market cycle. And we think we've got a diverse portfolio in the core space here across a number of categories. And a lot of these names I've just touched on previously. So just turning to the last slide for my section, I just wanted to touch on the longer term return profile for our core Australian equity portfolio. It's undoubtedly been a tough sort of 6 and 12 months for the portfolio on a relative perspective versus the benchmark. We've continued to produce positive absolute numbers. And the majority of this recent underperformance has just come in the last couple of months, as you can see, the last couple of quarters, sorry, you can see there on the bottom chart. And this short-term underperformance has been really driven by us not owning a couple of key positions in the buy now, pay later space, as well as not having exposure to Westpac and ANZ, which have benefited from, as I said, the rate moves and recent momentum. However, we continue to believe that our disciplined approach to stock selection and portfolio construction, hopefully you can see here on the top table, provides a consistent long-term return profile, both in terms of absolute return numbers, as well as our ability to outperform versus the market. So with that, I'll hand over to Chris.
Thanks, Dom. Maybe Hugh, if you can go to the first slide, please. Thank you and welcome everyone. Just by way of background, the small or the SMID, the small mid-cap part of the market is those companies which are outside the top 50, ASX, top 50 companies. So it has a lot of less mature business models, more high growth type of companies in sectors like healthcare and technology, as well as a lot of attractive mining or resource stocks, which we seek to take advantage of. Now, the last couple of months have been a bit tougher for some of these high growth and better quality parts of the market. And this has impacted our performance to some extent, relative performance, because we are overweight those sectors. Now the reason for those positions in those sectors, which are high growth, better quality, and so forth, is that we believe that that's where the longer term returns have been the most compelling and will still be for years to come, despite corrections you get from time to time and so forth in the last few months. Now, importantly, we don't own concept stocks like Afterpay, for instance, which aren't currently earning cash flows or profits, but all the companies we own in the technology space are earning positive cash flows as we sit here today. It should also be noted that many of the value stocks that have rallied recently tend to be at the lower quality end of the spectrum. Stocks like Nine Network, Ingham, Pact Group, and these sort of companies typically struggle to earn decent returns through the cycle and are definitely more prone to earnings downgrades when more competitive environments take over. This is why these sort of stocks tend to be longer term underperformers and why we're normally keen to avoid them. And this is important in the context of the current somewhat confusing macro environment where rising bond yields are pointing to potentially longer term inflation. But if this occurs, it is typically those companies with pricing power, a strong competitive moat that can take advantage of such conditions. And the potential, therefore, to offset the current valuation impacts from rising bond yields. And if we ultimately get inflationary pressures, then this will lead to higher interest rates, and that will eventually temper the demand and ultimately the earnings of those more cyclical value type of companies. Where we have been exposed to cyclicals is more on the global arena through resources, where, as I said at the start, there's a lot of attractive opportunities within that space, and we've had reasonable overweights for some time now in our preferred commodities. And those commodities are those ones which are typically in short supply and where there's a strong demand profile. The three most prominent ones being copper, our most preferred, then nickel, and then iron ore. And we can talk about some of the names there later if time permits. We are at the moment trying to increase our exposure to some of the better quality domestic cyclicals, as in companies which earn most of their earnings in the Australian economy. But as I mentioned earlier, they are typically in short supply. The key, as always, is to remain balanced, have sound exposures across all important sectors, but still target those sectors where we think the longer term returns will be the most compelling. Dom mentioned the strong reporting season, and you can see there our retail exposures. This was certainly the case in retail, which enjoyed probably the best retail conditions ever, some are suggesting. And we increased our holdings in City Chic and Baby Bunting, and we think we are well positioned here. There were, as is always the case, a few stocks which didn't go quite to plan, and that included Netwealth, which has repositioned its fee structure, Seek, which has made a fairly substantial and unexpected business restructure, and we've moderated our position accordingly, as well as Magellan Group, which isn't performing as well as we would like, and we are actively reviewing that position. We can go to the next slide, thanks, Hugh. So here you can see the quarterly performance profile for the SMID and combined with the longer term returns. And you can see, as the headline suggests, that there is a decent amount of volatility. You know, there are quarters where we are outperforming by in excess of 5%, some where unfortunately not going the right way. But despite that volatility, we are, as is the case with the core portfolio, able to generate some very solid longer term returns, and that remains our focus. So volatility does go hand in hand with smaller companies, both in terms of their business models and the share price performances. But we do believe that if we get the calls right, there are some really compelling returns for investors over the longer term. Thank you. And I think it's back to Piers now to take any potential questions.
Thanks, guys. There has been a couple that have come through the airways. I might just start off with you, Chris, on the first question, just in regards to that recovery leverage theme. And you've got a number of the companies there, Oz, IGO, etc. Can you just talk through the thematic that's supporting that? Obviously, Oz in terms of copper. We've got nickel there as well with IGO, but you just want to talk a little bit about that thematic there. That was a question, just wondering, have those companies, is there more upside for them?
Yeah, well, Oz and through the copper exposure, the copper is the commodity that we are most positive on because there's simply no new sources of supply coming on stream. And well, with the exception maybe of Oz itself, who have a number of new projects in train. So copper is the ultimate global industrial material. It's used in a variety of applications and increasingly and somewhat excitingly in many of the environmentally sound projects, including clean energy, electric vehicles and so forth. So we think the demand for copper is both cyclically and structurally likely to stay very solid for some time to come. And Oz have a nice exposure of both producing copper mines through Prominent Hill and Carrapateena, which is the one that's coming on stream now, plus a lot of projects scattered around the world. Oz also has about 20% of its earnings coming from gold, which, although that hasn't worked so well in recent times, can be a nice little hedge to Oz, and it's a nice source of cash flow for Oz as well. So Oz, we not only like copper, but we think Oz is particularly well placed in that sector. On the nickel side, we own Independence Group, which has the Nova mine in WA, so which is near Kalgoorlie. So there's no sovereign risk there. It's one of the lower cost nickel producers in Australia, and they've just recently made a play into the lithium space as well. So Independence, similar to WOS, are trying to go down the sustainability path as well, and lithium is the most dominant element used for the making and production of electronic batteries and so forth. So that covers off on nickel. Nickel itself is used increasingly in electric vehicles as well as for the production of stainless steel. And then finally, we own Mineral Resources in the iron ore space. Now, iron ore, obviously, the dominant market for iron ore remains China, and that will remain the case. But like the other commodities, it's getting very hard to find economical deposits of iron ore that can be exploited within a reasonable time frame. So, most of the iron ore in Australia comes out of the Pilbara, but it's got to be relatively near the coast, have access to infrastructure and port access to be economically exported. So they're having to go increasingly further out into the eastern parts of the Pilbara to find more deposits. But Mineral Resources has all those requirements in place, and is forecast to massively increase its production over the next few years.
I think it's interesting on that front, just to talk around with Oz and both Independence Group as well, just in terms of the usage of those metals, particularly as it relates to development of green energy, particularly over the coming decades, effectively. And so the sustainability focus that we have within our portfolios across those businesses, and every business that we hold in the portfolio, I think also is an important element of sort of the process that we undertake, and how that can contribute, as I said, back into the environments they deal into. So thanks for that. Dom, just one your end, just on the banks, just to follow up here on the banks. You made mention that obviously talked about CBA and Macquarie. Question here, do we own all four banks, or you note there that clearly we don't, but do you want to talk about where we've got our bank positioning in the portfolio?
Yeah, we ideally we want to run a concentrated portfolio in both the large cap and small mid cap space, and where each position is a alpha driver. And so in a portfolio of 20 to 25 stocks, we don't think it's necessary to own all four big banks, given they are largely very similar now in terms of their operations after divesting multiple other assets and et cetera, getting back to core banking. So really we only own CBA and NAB in the big four space. We think that NAB provides a lot of operating leverage to an improving economy, given they are leader in small business loans. And then we also like the quality and size of CBA. There's always a long-term question around, should CBA trade at a slight premium to the others like Westpac and ANZ? Our view is yes, they are probably 12 to 24 months through repricing, management changes, paying fines for past indiscretions. So from that regard, even though it is slightly more expensive on a price to book or price to valuation metric, we think that's justified because, the likes of Westpac are still going through a number of management changes, still looking to divest some of their assets. And similarly with ANZ, we think NAB has a bit better operating leverage there. So in terms of order of our preference, it would be Macquarie for its diversified nature in the financials, but if it was big four banks, we've got CBA and NAB and no exposure to Westpac and ANZ.
Right. Another one for you, Don, just on James Hardie. Obviously their record result, but we have started to see, as we've been speaking about today, obviously bond yields move higher, and obviously in the US, housing is priced off the yield curve as opposed to the official cash rate. Do you think a higher 10 and 30-year yield curve is going to have an impact on James Hardie for 2021 and beyond?
It's a good question. Certainly it has some impact on the borrowing costs for new housing, but a large proportion, or the largest proportion of James Hardie's revenue comes from actual restoration and remodelling. And so overall, with an improving economy, you would expect house prices to rise, and that's the point in time where people start to reinvest in their own homes. And so that's the part of the market where we're seeing a lot of growth for James Hardie with interiors and externals. A huge proportion of the US housing market is still vinyl, which is essentially, if you wanted to take an ice cream container and staple it to the front of your house, that's what it looks like. And so, that doesn't last for very long. And James Hardie products, again, on the theme of sustainability, they're out of their European fibre cement, they're now down to 100% fully recycled fibre cement, and the longevity and life cycle of fibre cement versus vinyl is extraordinary. So people are seeing the value in, as I said, restoration and remodelling. So hopefully we get a bit of a double whammy there. Even if yields increase and the cost of borrowing rises, that might dampen new housing construction, but overall the restoration remodelling market remains strong.
And even on that new housing side of things, I mean, there's still a significant shortfall in terms of, where they need to be in terms of new housing versus sort of the demographic side of it. So even though there is potentially an impact, as Dom says, we don't expect that net it will be negative for Hardie, certainly given their broader position. Chris, one for you, mate, just on Tyro. The impact, obviously, of the terminal outage. Do you see that that's going to be, a structural issue for them, or do you think that short-term turnaround things are going to look positive?
Yeah, well, it's obviously an episode we would prefer to have not seen, but it was a big focus during the result and calls and a follow-up conference we had with them. We're very confident that they're on top of the issue. There's obviously been some disgruntlement out there, but they've been able to restore most of the services now, and we haven't really seen. The key thing we were looking for was a dramatically increased rate of churn in terms of the existing merchant base, which we didn't see at all. And in fact, we're seeing pretty well normal levels of new applications for terminals, which is also pleasing. So I think that's why the result was received so well. That there wasn't a massive fallout. And, we have every confidence in the company, and particularly that the CEO, Robbie Cook, who's a very sound operator, that he'll be able to get on top of this. Look, there'll be some impact to this half's earnings as they both compensate and fix this issue. But we don't see it, because they've handled it as well as could be expected. We don't see it being a longer term impediment for the company, and we're committed to our position.
Yeah, terrific. And Don, just another one, mate, on Transurban. As you pointed out, probably we know why it's been impacted, but probably the question here is more, once we get through COVID, do you think traffic volumes will start to pick up? And obviously some of the development pipeline coming through, is it still an attractive asset?
Yeah, I think long term it's certainly an attractive asset. Near term, it's a balancing act between anecdotally we know and we can see traffic volumes improving. We don't expect localised lockdowns with the rollout of the vaccine over the next sort of 6 to 12 months. But that is then being offset by the rising bond yields, and long dated infrastructure assets are arguably one of the most impacted sectors from a rising bond yield environment. And so that does discount back our valuation slightly. And so from that regard, we're only modestly overweight, if anything more neutral on our positioning on Transurban, and looking for a more sustained recovery in traffic volumes. Pleasingly, the key thing that's keeping us in the stock is heavy vehicle movements have maintained really strong pace, and they are generally paying sort of 1.5 times in toll. So that's a positive driver. Overall, long term, we still like the prospect for Transurban to acquire new assets, both domestically and offshore, as well as expand on their existing asset base. So that's things like lane widenings, etc., which all help to drive long-term revenue for Transurban.
Thanks. We've got a question here just on the Aussie dollar. I might take that one. Where do we see it going through the course of 2021? So the Aussie dollar at the moment sort of tracking around about sort of 77, 78 cents, and it's sort of been at these levels, sort of nearly touched above the 80 cent mark you know, in the early part of this year. But when we look at sort of the dollar over the last sort of 10 to 15 years, it's basically averaged around about sort of 77 cents. So I know probably a lot of people, if you go back thinking it more like should be in that sort of 68 to 72 range, but we have seen the dollar, as I said, have that step change over the last 10 or 15 years. So where we sort of look at it at the moment, we wouldn't say that the dollar significantly overvalued at all. In fact, we've probably got a range that can move upwards of north of 80 cents if you know, the growth environment really picked up quite significantly and we saw commodity prices move demonstrably higher from today's levels. So when we think about our dollar exposure across our portfolios, clearly all the companies, by and large in our portfolios, most of them, nearly all have some form of offshore exposure, so they are impacted. Some do look to hedge their positions as it relates to the Australian dollar and moving the Australian dollar. But certainly in the way that we've been thinking more broadly in terms of our portfolio positionings, we have been adding to our $A exposure in terms of our global equities. We continue to expect that the dollar will remain well supported, certainly through the first half of this year. And if growth does pick up in a more overt fashion through the rest of 2021 into 2022, that could be, as I said, beneficiary. The Australian dollar could be a beneficiary of that. So we're certainly not lightening our load as it relates to the Aussie dollar in the near term. So on that basis. Got one come in. The extreme pressure on the ASX 200, where we see the ASX 200 will be at the end of the year. Well, we don't have a crystal ball that's that accurate, unfortunately, and we don't really sort of put a definitive number on where we expect either the ASX 200 or any market to be at any particular point in time. We do a lot of work around you know, the modelling in terms of sort of our capital markets and the like, but we don't, as I said, put a figure on the market. But hopefully you would have gleaned from today's conversation that the first half reporting season was a solid first half reporting season, and you know, we certainly do remain constructive on the outlook for equities, and you know, the growth environment that we believe will continue to come through the rest of this year and beyond. It might be a different growth environment in terms of financial market performance to what we saw through 2020. I think we probably most definitely will be, but it doesn't necessitate that, as I said, there aren't opportunities in the equity market environment. So in the context of the ASX 200, you know, we certainly do envisage it will be higher throughout the course of this year. What that number looks like, we don't have a view on, but as I said, we're certainly planning and positioning our portfolios for growth, and it's really delivering into those longer term numbers that both Dom and Chris spoke about. So we haven't got any other questions coming through. We're sort of 45 minutes, so I might wrap up on that basis. So first and foremost, thanks very much for everyone attending today's session. We'd certainly love to hear any feedback that you have on the session, other sessions you might like to hear from, or other elements you'd like us to deep dive in. We really appreciate the support that you provide us, and obviously provide the firm more generally. And we look forward in touching base again soon. Thanks, and bye for now.
Thank you.
Thanks.